Finance's evening lecture series program, The Cryptocurrencies Markets, Where is it Headed? I'm David Cowan, President and CEO of the Museum of American Finance, and we're very excited to bring you yet another program that is both inspired and sponsored by the museum's Communications Executives Advisory Panel. I'd like to acknowledge the support of the lead sponsor, Protiviti Global Business Consulting. Protiviti has 7,000 employees serving clients from more than 85 offices in over 25 countries, and they've consulted for over 60% of Fortune 1000 companies. Our co-sponsor this evening is Van Eck, a global investment manager with over $80 billion under management, 60 ETFs, 5 active strategies, and 330 colleagues. Least known fact is that they sell apparel on their website, including an Alexander Hamilton tie. And I mentioned this because a few years ago, Jan Van Eck sent me one of those ties, and that started the Museum Van Eck friendship. Now, for some of our guests, this might be your first time tuning into a museum event, and tonight's program is emblematic of the museum's mission. We educate the public on the history of finance, the current state, the future of financial markets, and their important role in driving the American economy. This program builds on 2 previous sold-out events like this one on this important topic. In 2015, the museum held Bitcoin and the Future of Payments Technology, and it featured then the CEO and co-founder of ItBit, Charles Cascarilla, who actually joins us again tonight. And that evening, we gave out a fractional $5 share of Bitcoin through panelist Jeremy Allaire's company, Circle. And boy, if you had held on to that, you had made an incredible investment. Our moderators at that time were from the Wall Street Journal, Michael Casey and Paul Vigna, and they came back again 3 years later in 2018 with the program, The Blockchain and the Future of Everything, that featured the Winklevoss twins and Joe Lubin. So here we are, 3 years later, we're back again for the 3rd installment. So much has happened in crypto since then. We need a fresh look at this quote unquote financial revolution. Now, as a reminder, we are accepting Q&A through the question box below. To submit a question, most of you know how to do that. Just type it in. We'll try and get to it after the panelists are done with their discussion. And therefore, before I turn it over to Protiviti's Michael Browneyes, he's going to introduce our panelists. I want to share that the museum is accepting donations tonight through our Text to Donate platform. You'll see that in the chat area, and it's in front of you now. These donations will go to future initiatives of the museum to educate the public on the important role of cryptocurrencies in our financial system, and we are definitely planning a museum crypto exhibit. So if you're interested in supporting that or getting involved, please reach out. And best of all, tonight, as you can see, we are accepting donation in crypto. Now it's going to be my pleasure to turn it over to Michael Browneyes of Protiviti. Now he leads both Protiviti's North American financial services and global regulatory compliance practices. He directly and through his team advise a myriad of financial and insurance firms on a wide range of issues, including complex regulatory risk and compliance matters. He's frequently quoted in outlets like the Wall Street Journal, the AP, Reuters, and American Banker. And impressively in 2018, Michael was named to Consulting Magazine's top 25 consultants list. It's my pleasure to turn it over to Michael Browneyes of Protiviti.
Great, thank you, David. Protiviti is proud to partner with the museum. As David said, we have a great partnership that we're excited to continue with this outstanding event. And I'm honored to be a part of this program. I think, wow, what an amazing time for us all to be talking about crypto. We're roughly 12 years now since the creation of Bitcoin, and really from the beginning, many thought that cryptocurrencies had the potential to be one of the most disruptive economic forces of all time. And it certainly seems that although that's happening in fits and starts, clearly we are moving down that path. And true to that form, if we look back just over the first 9 months or so of this year, I think you could argue that we've seen more disruption and more innovation and more groundbreaking news in the crypto space than we probably have in the past 9 years combined within traditional financial services. So just a few examples of that. We saw this year alone hackers steal and then return, at least for the most part, $600 million from a large crypto exchange. And they explain why they did that is essentially to highlight security vulnerabilities in the platform, and that they thought a worse actor was going to steal the money first if they didn't get to it before they did. We've also seen an incredible amount of news on the regulatory and governmental front. So within just the past couple of months, El Salvador, we all know, became the first country to make Bitcoin its country's legal currency. And lest we think that that was going to become a consistent trend, obviously huge news last week with China, for now at least, essentially banning all cryptocurrency transactions in the world's second largest economy. And then here in the US, I think it's increasingly clear to all of us that the SEC in particular, other regulators, I think likely to include the Federal Reserve soon, will be addressing crypto with a heavier hand than they've had up until this point, and likely that stable coins will be the first target of formal regulation in the US. So really excited that we've got some outstanding regulatory experts on the panel. We'll hear their voice tonight on likely winners and losers as we enter a more restrictive regulatory environment. So with that in mind, I'm very excited to introduce all of our panelists tonight. We'll start with Brian Brooks, who served as the Chief Legal Officer of Coinbase, the well-known US Bitcoin exchange, as well as the General Counsel of Fannie Mae. Brian's also very well known as having held the role of Comptroller of the Currency under the Trump administration. Under his watch, we saw the regulatory infrastructure for crypto advanced significantly, with the OCC as a unit of the Treasury Department releasing guidance clarifying that banks could provide crypto custody services and use stablecoins to facilitate payment activities. These moves help make it easier for traditional financial institutions to get into crypto, and that's definitely a strong trend that we've seen continue even after Brian's departure from the OCC. We're also joined by the Honorable Chris Giancarlo, who currently acts as Senior Counsel for Wilkie, Farr, and Gallagher, the law firm. Chris is known as Crypto Dad for his call in the US Congress to acknowledge this generation's unique interest in cryptocurrency, and also served as the 13th chairman of the US Commodities and Futures Trading Commission. Chris has held several senior roles as well on the US Financial Stability Oversight Committee, the President's Work Group on Financial Markets, and the Executive Board of the International Organization of Securities Commissions. Chris also has I think, a really interesting book coming out shortly entitled Crypto Dad, The Fight for the Future of Money, and that'll be released this coming month in October. Charles Cascarilla is the CEO and co-founder of Paxos, and Charles brings over 20 years of experience in financial services and has been on the forefront of integrating blockchain technology with traditional payment systems. And as a quick spoiler alert here, Paxos supports the move to regulate stablecoins, but is also opposed to the use of powers created under the 2010 Dodd-Frank Act that allow an entity called the FSOC, which I mentioned a moment ago. It's made up of the Treasury Secretary, the Federal Reserve Chair, and 13 other top federal and state regulators and financial experts to effectively extend its reach to stablecoins by declaring stablecoin activity or companies systemically important. So clearly this is a critical challenge and I think evolving set of circumstances facing the industry, and really look forward to hearing the panel's thoughts on how that's likely to play out in this afternoon's call. Jan van Eck is the CEO of Van Eck. Van Eck has been known for empowering investors with forward-looking, intelligently designed mutual fund and ETF solutions in emerging markets and commodity-related investment strategies. Jan founded the firm's ETF business in 2006. The firm was also named in 2020 ETF Provider of the Year by Fund Intelligence. Jan's a director of the National Committee on United States and China Relations, and really looking forward in particular to hearing Jan's perspective on the regulatory hurdles his firm is facing in the future of ETFs, as well as obviously I mentioned the big news out of China, and I think Jan will have great perspective on that from multiple fronts. And then finally, very happy to introduce our moderator, Camilla Russo. Camilla is the founder of The Defiant, and before her current role was a markets and crypto reporter at Bloomberg News in New York, Madrid, and Buenos Aires. She literally wrote the book on the history of Ethereum in a publication called The Infinite Machine, and is originally from Santiago, Chile, here with us live. And over to you, Camilla. Really looking forward to your questions and hearing the panel's thoughts. Thank you.
Thank you, Michael, for the introductions, and David for the great opening remarks. And for thank you to the Museum of American Finance for having us all and having coordinated such an amazing group of panelists. Really excited to be here as well. So to start, I know that the introduction focused very heavily on regulation, and we will definitely get to that very quickly. But I want to start with a more optimistic note, and that is of highlighting just all the recent announcements from major US and international companies and how they are embracing crypto. Just today, Visa announced it is building a layer 2 based payment network using Ethereum. MasterCard announced it's also taking crypto in its payment network earlier this year. Robinhood said it plans to offer a cryptocurrency wallet. Twitter is offering Bitcoin tipping and verified NFT avatars. So it really seems like we're on the verge of crypto finally becoming mainstream, kind of this mantra that crypto insiders have had basically since Bitcoin started, being mined in 2009. When will this become mainstream? Well, it seems like it's finally happening today. How far do you think crypto will blend with traditional finance? And what still needs to change for financial markets for crypto to become even more ubiquitous? And I will pick on Jan for this to take this one first.
Wow. Well, I would say you just listed a lot of important developments. I look at crypto disrupting finance in 3 dimensions. One is brokerage, just a simplistic advantage that Coinbase offers, the 24/7 trading, instantaneous settlement. So we can go on there. Secondly is payments, and a lot of what you mentioned really has to do with payments companies incorporating crypto, and I would include remittances as that as well. And I think you look at the established players like Visa and MasterCard in the payment space being, in a way, I would say, threatened by crypto because their pricing power is still very, very strong. But I do think that crypto is threatening that second space, payments, and then lending is the third. The DeFi, the borrowing and lending, earning interest through stable coins and lending other tokens is the third area. Just to size it, right? I don't know, Charles knows better than me, but there's over $1 billion in stable coin assets these days and $1 billion in DeFi. So still teeny compared to the multi-trillion-dollar ETF industry or lots of other industries, but clearly lots of money as well.
Oh, and for other in the panel, if you want to add to this, my like the first part of my question, which was how will crypto integrate with the rest of traditional finance, do you think? Because I think there's different camps on this. Like, one is that crypto will forever be this parallel financial system. Another view, which is there will be these traditional kind of interfaces that fintechs provide, but then the crypto will be kind of the plumbing behind all this. And then a third camp, I think, which is basically crypto protocols will take over finance, and the primary way where that users will interact with finance will be through their blockchain wallets, and just the whole experience will be transformed. So I don't know, like, interested to hear where you guys fall on this.
Hey, Camilla, maybe I can just jump in with a couple of thoughts. So one analogy would be a look at what happened with earlier versions of the internet and what happened to their underlying kind of constituency competitors, right? So think about in the early days of the internet, at least in the early days of Internet 2.0, kind of the commercial internet, what many people use the internet to do was to price compare and everything, but then they would go down to the mall and they would buy stuff at the mall, having shopped around for the item they wanted in the cheapest price, right? People don't really do that anymore the way that they did for a while, because underlying infrastructure got built up that now allows same-day delivery and all kinds of other things. And the result is that kind of the brick and mortar, commercial economy that we had 20 years ago doesn't exist the same way it did then, and probably never will again, even though there was a period of time when it looked like they would coexist. And among the inventions that made that easier were things like real-time delivery, but also things like DocuSign and other things that made it unnecessary to ever leave the internet. Whereas for a while, you could look for things and you could get information, but you couldn't really buy and sell and contract on the internet until other protocols came along. My prediction is that a very similar thing will happen in financial services, where for a period of time, there has to be a coexistence, because people will take dollars from the bank and they will then put those dollars on Coinbase or another exchange in order to access the internet of value, right? The crypto economy. But then there will be times when they want to make payments or, sell their crypto, at which point they cash out and go back into the normal financial system. But that won't persist forever, because innovations like stable coins and other things will allow people to stay inside of the internet, inside of the crypto economy, without having to deplatform. So I think there's a short-term world where these all coexist, but a longer-term world where the world will go on network, and the banks and broker-dealers that figure that out and become nodes on those networks and participate, they'll survive and do well. But many traditional organizations will not. And I think that's what the internet shows us historically.
And Camilla, can I just build on that?
Yeah.
What Brian just said? You began the question by saying, is crypto mainstream? And I'd say crypto is mainstream if you're 35 and under.
Mm-hmm.
One of my favorite authors, the author of The Hitchhiker's Guide to the Galaxy, says that anything that's developed before the age of 35 in your life is logical, makes sense, is completely the basis for a future career. And anything that was developed after you've become 35 is suspect and needs to be dismantled and destroyed as quickly as possible, or something to that effect is this quote. And I think we've got that going on right now. I think a younger generation intuitively understands crypto. They may have grown up with video games and with trading tokens or other things, but they totally get it. And they don't get actually the way an older generation still writes checks to pay for services. And my 89-year-old mother writes checks, and my 26-year-old daughter wouldn't know a checkbook if it hit her in the head. And so what we've got right now is a generational change. And as with all generational change, the new generation is going to dictate the future, not the older generation. So this is coming. It's mainstream already if you're 35 and under, and in a few years, it's going to be mainstream in the general population.
Right now, it seems like there's agreement that crypto going mainstream is inevitable, but there's still uncertainty as to how we get there, especially when it comes to regulation. This year has been intense in terms of statements from different regulatory agencies, especially the SEC with Gary Gensler has been very aggressive in regards to crypto and how it plans to treat it. So right now, I think there's a little bit of fear coming from the cryptocurrency industry that they're not sure where they are standing. What role does self-regulation have in crypto at this point, and how to make this extremely new technology and industry fit into laws and rules that were written, in the 1930s? Do we need to come up with a new rule book? Can crypto fit in the old one? And yeah, maybe this is Brian or Chris can take this one.
Well, you know what? I did a paper on self-regulation in crypto a few months ago, and maybe I can summarize the point there. But it's actually quite shocking that the public sector here in the United States is not advocating self-regulation for crypto, because self-regulation has worked extraordinarily well in US financial markets. Self-regulation goes back to the 1850s in the commodity markets that I had the honor to oversee at the CFTC 60 years before the federal government, 70 years before the federal government came along to add a layer of regulation. Self-regulation exists today in our commodity futures markets, exists today in our securities markets. And it's one of the reasons that those markets are the world leading markets in their activities. So the reason why the United States commodity futures, the United States securities markets are the world's largest, the most liquid, the greatest depth, is because self-regulation brings a level of expertise to the market that national regulation can't bring. It gives the participants in the market a stake in the game, skin in the game for how those rules work. Self-regulation works, and self-regulation must be part of the conversation around crypto. If we're going to have a crypto environment, a crypto marketplace that's as successful as our other financial marketplaces here in the United States.
Yeah, so let me build on that just for a second. I agree with all of that, 100%. But Camilla, let me go back to the premise of your question, which is how is crypto going to comply with the existing set of laws? That's a weird way in a dynamic market economy to think about a new innovation, is how is it going to comply with existing rules? The analogy that people in crypto use a lot is when YouTube came along, nobody thought that the question was, well, how in the world is YouTube going to comply with FCC broadcast license requirements, right? Even though it was distributing television content, because it wasn't using the airwaves. And the point often of innovation is to take an activity that was flawed or risky in some way and build a technology solution that eliminates those flaws and risks. So just to take an example, one of the things that people are often worried about with crypto is the prices are so volatile. But think about it. The government doesn't regulate price volatility in any other market area. There's no rule that says stock prices can only go up, and the government doesn't guarantee that they don't go down. The whole point of the market is to bring price discovery and to allow prices to go up and down. What most of financial regulation is about are various forms of human fallibility, right? So a lot of the rules around the securities laws are making sure that investors have disclosure about who the management team is, what the financial position of the company is, and everything else, to make sure that the management team isn't defrauding the company. But the beauty of crypto projects when they become decentralized is there is no management team. It's a bunch of computers running algorithms and validating transactions once decentralization has been achieved. And so the whole point is to make sure there isn't a management team that matters, right? That's solving a securities problem, not an issue that needs necessarily to fit within securities rules. Or if you think about my field of banking and bank regulation, a lot of bank regulation is about governance, the idea that the board shouldn't be making loans to itself, or that the company shouldn't be engaged in self-dealing, or that there should be risk management and credit underwriting going on in a sound way. But again, the point of some of these crypto DeFi projects is to do all of those things by algorithm. So there is no person to be doing self-dealing. So if crypto actually achieves what its mission is, then to me, the right question is, how do we make sure that regulation doesn't prevent the technology solution to a bunch of historical problems? The question isn't, how do we make sure that every new thing complies with a bunch of old laws? It's to make sure that the tech is solving for those laws versus running into them. And that's a different way of thinking about it. But I think we need to get the idea that the activity comes first, and then we figure out what, if anything, needs regulation, as opposed to thinking that the regulation comes first and no one should do anything until they can show they're complying with that regulation.
100% agree. But as you were speaking, one aspect, came up, which was KYC, and that's been kind of the focus of a lot of regulatory discussions. And while yes, on some respects, crypto does solve for the aspect of governance and management teams, it's the point of KYC, I think, becomes really tricky, because for decentralized protocols that simply don't compile any of that information from users, they are still being asked, potentially they may potentially be asked to comply with KYC AML laws, where they simply can't, because they just do not, there are smart contracts, and users are, they're just directly interacting with these smart contracts without like signing any forms or giving out any information. So that's kind of the issue where, there's
Camilla,
the chance that like Yeah.
If I could jump in on KYC for a second, when we think about KYC, we have to separate the purpose from the process. Okay, the purpose is to prevent money laundering and illicit activities. And that's an important public policy that we need to make sure extends to this new innovation. But the current process of KYC, let's be honest, is not terribly effective. I've seen somewhere that the amount of false positives in KYC reports is over 90%. So the existing process is mediocre at best. If we say, though, that the policy can only be achieved through the current process, a process that is mediocre at best, then we're going to hold back innovation simply because we're wedded to a set of procedures, as opposed to looking more broadly as what are we trying to achieve? Let's look at this new innovation, this new technology, blockchain, big data analysis, AI, to look at pattern recognition. And actually, maybe we can actually achieve more of our public policy if we stop being so wedded to our existing account-based identification approach, which, by the way, is incredibly exclusive. And it means that a lot of people cannot access financial services because we're so wedded to an account-based approach that people that don't have identity cannot access. Maybe if we take full advantage of this technology and tokenization, which will allow more people to participate, and instead of trying to identify every party to every transaction at the outset, and start looking for patterns of illicit behavior, and then work our way back to identifying parties, we may actually be able to get better KYC without holding back the innovation, because we're wedded to an old process.
Yeah, I think
I love that.
That's incredibly well put. And Chris, the only thing I'd add on that, just to take it one more layer of specificity here, is the thing that you have to do in traditional banking and broker-dealer regulation is you have to go and collect, name, address, taxpayer ID number, and those kinds of things. And that's the incredibly costly yet incredibly useless existing system that Chris is talking about. In the world of crypto, and particularly DeFi, which is where your question really becomes most critical, we have to ask ourselves the question: do I care whether I'm transacting with Chris or Camilla? Or do I just care that I'm not transacting with a money laundering address or a terrorist, right? Because if I don't actually care that you're Camilla, I only care that you're not a bad person, then crypto offers lots of blockchain unique opportunities to do that based on large numbers of network observations and pattern recognition, as Chris says, in which case crypto is actually advantageous over the current system because it can do a really good job of predictively saying that you are or aren't a bad person, but it also can protect the privacy that ought to be the legitimate interest of anybody in a free society. The only reason we don't have that historically is because the only way of knowing you're not Osama bin Laden is to know that you're Camilla. But in crypto, I don't need to know that you're Camilla anymore, so I can be better and also more privacy protecting.
I really love this approach. So the idea is look at the goals that regulations have, and not the processes that they are covering to get to those goals, and instead use technology to get there, leveraging this new innovation in a way that you can still achieve those goals, but in a better way that doesn't limit the growth of this technology. I think that makes a lot of sense. So far, that hasn't been, unfortunately, the current approach of regulators. And so one, might start thinking about intent.
Exactly.
It has.
It has for some of us.
Well, yeah, but I guess not for a part of regulators. I should clarify. So you can start thinking about or wondering about the intent of some agencies and regulators, and we see them saying that stricter cryptocurrency regulations are to protect consumers. But when you start thinking about if that's actually the case, when us in the industry realize how much consumers can actually benefit from this industry, is it really consumer protection, or is it more an increased control of the market? Like people in crypto will say regulators will regulate. That's what they do. But is this, I don't know, a more like simplistic take.
Well,
well, maybe I could just quickly jump in and also,
yes, please.
Chris and I, as you know, do this together a lot. And a comment that one of us always makes is, look, it's not so much consumer protection and investor protection, though that's part of it. It's really incumbent protection. And that's because the way in the United States we structure our regulatory regime is there's kind of one agency for each entity out there. So my agency regulated banks, Chris's agency regulated designated contract markets and clearing organizations and certain other kinds of entities. And so usually the people who run these regulators are really focused on protecting their own turf, which is to say they're incumbents. So just in my own experience, historically, the bank regulators didn't like things that were going to disintermediate the banking system, right? And DeFi is a threat to the banking system. Some of these decentralized exchanges, as Chris will tell you, we're going to sort of challenge the existing derivatives markets. These are tough things if you're trying to protect your turf.
And I'll be quick because I really want to give Charles and Jan a chance. But chairs of agencies have a lot of discretion, and a chair can decide we're going to enforce every rule to the very letter, and we're going to be aggressive. Or chairs can say, you know what, our rules don't really apply in a lot of cases to this new innovation. Maybe we actually need to clarify some of our rules first before we go guns a-blazing. And that's something I wrote about this in my book, that at the CFTC, we had a problem where CFTC's jurisdiction is based upon whether one is operating in a derivative market where there's future delivery, or where what's called a spot market, where it's physical delivery, where the CFTC doesn't have jurisdiction. And it was clear that there was no clarity as to what does physical delivery mean in the context of cryptocurrency. And the agency was getting ready to do all kinds of enforcement action against firms for crossing that bridge without clarity from our agency. And we decided to actually put a pause on enforcement, sit down, clarify our rules, publish our rules, and give the marketplace 3 or 4 months to digest that and make adjustments before we resumed enforcement action. Now, that was a matter of discretion that a chairman and an agency has, but we decided when you've got a new innovation and you've got an old set of rules that apply to a different world, it was incumbent on us, we felt, to clarify our rules first before we went in with our 20-pound boots and our enforcement action and guns a-blazing. Now, not every chairman comes to it like that, but that was something that we felt was important. And so I think that there's a lot of discretion, there's slack in the system. It doesn't have to be wooden, it doesn't have to be guns a-blazing every time. And I think that if we in the United States value innovation and what innovation can do to make our system more inclusive, less costly, faster, with less friction, if we see in this innovation the potential from that, I think we ought to exercise, I think regulators ought to exercise discretion. It's incumbent upon them to clarify their rules and then enforce, but do it where at least the marketplace is on notice is what's expected in a new paradigm.
This one for Charles. I mean, we've been talking about regulation in theory, but then it comes to how it affects in practice the projects and companies and protocols in crypto. And stablecoins have been, under a lot of scrutiny in the recent statements by regulators. So I'm sure you've thought about this in great detail. What happens to Paxos if regulators want to limit stablecoin transactions or regulate that part of digital assets more strictly?
Well, we always want there to be an opportunity for us to make the biggest impact possible. And so, the way we've approached making that happen is by being very regulated. So from the very beginning, we've approached Paxos to ask for permission, not for forgiveness. And so we're the first firm to receive a New York State trust charter in May of 2015. We've gotten a lot of other different types of regulatory approvals, both in the US and outside of the US. And that's important because when you hold different types of assets, whether they're cash or crypto, stocks, commodities, you need to have different types of approvals. And so they allow you to hold assets and move assets. Different regulators oversee different things. And certainly the approach that we've taken is premised on the idea that regulation allows you to have the broadest possible impact with this new technology, because regulation is a way of creating trust. And so I think that the way the regulatory regimes are set up now cover most assets, not all assets by any means, but cover most assets, and certainly cover the concept of creating a stable coin, which is really just a dollar, but in a different format. It's no different than any other dollar if you construct it correctly. It's backed by cash, and you can back in other ways, but if you just back it by cash, it's really just a dollar. And so what you've done is made that dollar much more accessible. And I think you can do that in the current regulatory regime. I think it's very, very powerful. I know there's a lot of fear from, both incumbents and policymakers around what could this mean in terms of how the financial system will work. But I think the interesting thing is to allow the experimentation so you can find that out. And we're never going to be able to mastermind innovation. That's just not how it works. It's a creative process that needs iteration, and it needs a set of parameters that people can operate in freely. And so I think it would be a real shame for regulation to come out that really would limit it. On the other hand, regulation can come out that actually enables it, because it could create a lot of clarity. And so that's always the trick here is how can you create a safe playing field, but one that doesn't stifle innovation. And I'm hopeful that that will be the case. Certainly, Paxos is a lot more than about stablecoins. So, our goal is to replatform the financial system. And there's $700 trillion of assets in it, and dollars are just one component of it, a very important one, but just one component. So, there's a lot of innovation to happen. It's not just going to be about one thing, but the lifeblood of the system is dollars. In the crypto world, there's $130 billion of dollars now that have been tokenized. Actually, a little more than that. So, an enormous amount has been taken from traditional systems and moved into a blockchain-based rail. And there's a reason for that, because people want dollars that can move 24/7, 365, instantaneously, for lower fees, to be programmatic, to be open to anyone. And that's what you need. That's what crypto has shown us that you need to have. And so I think that's an important point that we need to make sure we keep in mind, so that regulation engenders more ways of experimenting with that rather than less.
So how do you think it makes sense that stablecoins be regulated, and where do you think it doesn't make sense?
Well, there's a number of different ways that different types of regulators that are possible. State regulators, the federal regulators. I think that having a primary regulator that oversees an issuer, for instance, in the case of Paxos, our primary regulator is the New York Department of Financial Services. But having a primary regulator that can see and examine what an issuer is doing and can look at the assets that are being issued is very important. And that was put out by the Financial Stability Board as one of the 10 key points in their guidance. What I don't think should happen is that it should be relegated to, say, something that's systemically important that only a few institutions could do. I think one of the beauties of crypto is the way it's democratizing innovation and democratizing access. And I think that what we could really lose by limiting the type of regulator or groups of regulators that could oversee a financial institution or a potential issuer is that now you raise the bar of what is needed to participate so high that no real innovators can meet it. And I think that would be really against the spirit of what we're trying to accomplish in crypto, but also I think the spirit of what we've tried to always accomplish here in the United States, which is to be able to create a level playing field that participants can understand, to be able to innovate on and compete, and allow the market to determine what is the right way to operate. And of course, it doesn't mean there shouldn't be regulation, but there is a point where things become too constricted, and then you can't have any innovation at all.
And can I just have a word on that one, Camilla? The Financial Stability Oversight Council is a committee. It's a committee of primary regulators. So on that committee is the SEC, the CFTC, the Federal Reserve, the OCC, the FDIC. They're all primary regulators of different parts of our financial economy. And the Financial Stability Oversight Council is a collection of meets of them. But there's no other, underneath that council, there is no independent regulatory agency. So the notion that somehow we would take some new emerging asset class and put it under that council, but with no independent regulator itself to regulator, is really it's quite remarkable idea. And I quite frankly don't know how it would work for a council that meets every 6 weeks or so with no infrastructure there to do it. They're really, a primary regulator, the way the council was envisioned, would there be a primary regulator that is a member of that council, but a primary regulator for each component. So the real question is not whether FSOC has some sort of role to designate stablecoins as systemic. The real question is what is going to be the primary regulator with the day-to-day responsibility? And that's not clear in some of these discussions.
I think there should be an entirely new body dedicated to crypto.
Well, I'm going to jump in on that. And I'm going to say again, why do we start with regulation and regulator first, as opposed to figuring out what the risks are, right? So people always jump, Camilla, straight to the question of, oh my goodness, how about yet another federal agency? Usually the more agencies you have, the more opportunity for arbitrage and gap filling and turf you have. So I think that's a terrible idea. The places that have the soundest financial regulation are places like the UK, where there's only one financial regulator. So start with what is the risk and regulate the risk. In the case of stablecoins, by the way, I would just say, to the extent that what a stablecoin is a token like Paxos has, and like Paxos builds for third parties, by the way, which is just a tokenization of bank deposits or short-term treasury securities, that's just a prepaid card. That's like a traveler's check. We know what that is. It's a payment instrument, and it really is regulated, if at all, by the banking regulators, state and federal. We know what that is. But of course, in crypto land, that won't be the only kind of stablecoin, because a stablecoin is a token of any underlying reference asset. And as we migrate to more of a crypto economy, and as crypto really goes global, it won't just be dollars that are relevant. It could be other crypto assets. It could be fractionalized pieces of bank balance sheets other than deposits. It could be lots of other things. So before we start saying, hey, let's just deputize another federal agency to go figure it out, I would focus first on what problem are we trying to solve here? And I think the problem we're trying to solve, which, by the way, Chad is probably the most eloquent exponent of, is to make sure that people who are selling these things as fully backed by and redeemable for dollars are in fact doing what they say they're doing, and not actually backing it by some real weird basket of corporate, sort of securities and things that have risk in them. That's a simple thing that has already been looked at by the President's Working Group on Financial Markets, by the OCC and others. These things should be what they purport to be, and they shouldn't be otherwise.
Yeah, no, 100%. I think that's a primary risk for stablecoins, and I think the primary concern with regards to stablecoins in crypto has been that every exchange or platform transacting in crypto need to be a bank or complying with or a regulated exchange, because then you risk happening what Charles said, which is you restrict the area for innovators to come and offer stable coins for loans or borrowing or collateral, if you require them to be regulated banks or exchanges.
Just for one quick second, that would be a little bit like saying that YouTube should only be operated by NBC, right? Because TV and only NBC has the licenses. That misses the point of innovation.
Maybe if I could just make one point separate from regulation. I think stablecoins were a brilliant innovation, and they solved a problem for crypto exchanges, which is, if you're trading on a crypto exchange, how do I just go to cash? How do I get dollar exposure? Because at the time, bank regulators were obsessed with know your customer, KYC, and they wouldn't let ordinary banks interface with crypto exchanges. That's why the regulators caused this problem. So, but what excites me is the fact that you now have a financial system that's instantaneous. And that is so much, and what people don't focus on is that's actually better from a systemic risk perspective than this T+3, T+2 traditional system. The whole Robinhood GameStop fiasco that happened over the last year, that wouldn't have happened in crypto land because risk is transparent, assets are collateralized, and transactions are instantaneous. So anyway, I just think that our financial system is going to T0. Now, whether we get these old mainframes reprogrammed within these legacy banks, or whether it gets built on top of Solana and FTX, I'll bet on Solana and FTX any day. But I agree it's a horse race. But that's really the exciting financial change that's going to happen, this decade.
Yeah, I couldn't agree more with that, which is when you replatform assets onto a blockchain environment, you make it open, you make it always on, you make it make innovation possible, you make it programmable, and it's clear that that's how the system should operate, because frankly, everything else in our lives already does. And if you think of it more just as information, financial information is very valuable and it's highly regulated, but it's just information. And we know how to make information move immediately and instantaneously. It doesn't have to go in batch processes that take multiple days. That's just because we're using legacy systems. And if we allow a new system to begin to develop here, I think it'll be amazing how fast the switch can happen. Alternatively, we can continue to live in, kind of the equivalent of like church Latin here, which is how the system is operating right now, programmed in COBOL mainframes. This doesn't make any sense. And I think everyone recognizes that now. I mean, we've now really advanced things so that you can get toilet paper on the same day, but yet you can't sell your stocks and get your money for it. It's nonsensical. One is a physical product, and the other is something that's been dematerialized for 40 or 50 years. Those mainframes should be, in the museum here. They shouldn't be what's powering our financial system. And frankly, it's holding us back in the same way that our old bridges and old tunnels and old highway system is. And we recognize that's a problem. And I think we all recognize this is a problem too. The advantage here is we have a clear next generation solution, that is available and can really change, access and innovation. 26% of adults are unbanked and underbanked just in the United States. Forget about the rest of the world where it's even much more significant. That's an unbelievable issue because the system, it creates exclusion by virtue of the cost that it has. It's not that anyone wants to do it, it's that they can't figure out how to use these old systems to operate at a lower cost basis. But there is a new system to do that. And that's the promise of crypto and blockchain ultimately. And so I know it can sometimes feel like, wow, this is just one giant Wild West speculative bubble, but that's not it at all. Just like the internet wasn't one giant speculative bubble in 2000. Sure, there was pets.com, but the market worked that out. There's also Amazon and Google and all these other companies that came out of it. And not to recognize that this process of creative destruction is crucial for us to be able to move forward as a society, I think really will hold us back in some very significant ways and potentially put us in a real position of falling behind in a sector that we've always been a leader in, which is in financial services and financial products.
Camilla, one of the things that I find most, quite frankly, disappointing in the last 6 months is we went from the conversation that folks like Brian and I were having of asking, what's the opportunity here? It seems that the only question that's being asked now is, what's the risk here? What's the risk in this new innovation? What could go wrong? What are the trouble spots? Somebody mentioned volatility, energy usage, illicit commerce. Yeah, they're all there just as they were there. That there were downside risks in the early internet. But fortunately, people in the early internet also said, what are the upside opportunities? And I think what's not being asked right now is, how can this innovation help to empower a better financial system, a faster, a more inclusive, a lower cost, a more innovative, a more widespread, a more diverse, a less concentrated financial system? We of course, we need to ask what are the risks, but we also need to be asking what are the opportunities and what's our public policy in advancing those opportunities. So believe it or not, the United States doesn't become a financial backwater because quite frankly, a lot of parts of the globe are embracing these innovations in a way that somehow we seem to be looking askance at, and And the question of what's the downside risk seems to be the major, if not the only question, at least right now in the environment we're in, which is a disappointment.
Agree. I think US regulators should be asking what's the risk, but what's the risk of missing out of the US becoming the central hub for cryptocurrency innovation? Because the genie's out of the bottle, this innovation isn't going anywhere. If US regulators limit it, developers will just go and build it elsewhere. Like I'm speaking with these developers every day for the Defiant. We're covering the space, and I mean, sure, there's like a lot of concern about what's happening in the US, but nobody's stopping. Like everyone has continued to build decentralized finance and Web3, and it is where the future is going. So hopefully there will be more clarity in the US, and developers and DeFi teams will continue building here. But if there isn't, yeah, they'll go elsewhere. And I think that's a huge risk for the US. I think there's also a paradox here that I wanted Jan to address on this space being so open and there being so much choice for investors. Like people can go on Uniswap and buy thousands of tokens directly. They can go on Set Protocol and buy on automated funds. Yet still institutional investors have to conform to these kind of wrappers to access a cryptocurrency still. And I think most investment banks and asset managers, the way that they're able to offer crypto is in this kind of very sanitized way through Bitcoin futures, derivatives, and maybe a couple of exchange traded products. The US hasn't even approved a Bitcoin ETF so many years after the first application was filed. So at VanEck, how do you manage this? Like how do you offer your clients crypto investment alternatives in a space where everything is there, like that you can access directly, but institutions are still have to can't really access all of this universe yet.
Yeah, no, as a registered investment advisor, we're placed at a huge competitive disadvantage against firms like Coinbase, that we're able to offer several cryptocurrencies to retail really with no limitations whatsoever. Listen, I think our role is to educate our investors, and there's so much education that needs to happen. This panel is part of it. But there is so much stuff happening now compared to 2017 in the using blockchain open source technology that it's hard to keep up. What I'd like to point out is in 2021, I think the big development isn't just crypto as a group or Bitcoin. It's really the emergence of smart contracts. First of all, Ethereum, its performance, but also the big upgrade that it's going from to proof of stake as opposed to proof of work. So that's a major software upgrade, but they've still processing lots of transactions. Then Solana and other kind of smart contracts. People understand that a lot of the blockchain applications are built on top of the smart contract software, which is what people talked about in 2017. So as a fund manager, just explaining it. Now, as a business operator, we have to offer funds where we can. So in Europe, we now have 5 crypto products. We have 0 retail crypto products in the United States. Hopefully that will change at some point. But the other thing I would say is, as a firm that was founded in 1955, it's our job to help work with the regulators. I hate to keep talking about the regulators, but in 2017, there are parts of the SEC that a Bitcoin ETF, most people don't care, but a Bitcoin ETF would go through one branch of the SEC, but we spend 99% of our time with another branch. Our branch cares about custody, right? They care about the safekeeping. That was a big deal in 2017. The other branch, I've never heard them ask a custody question ever. So, there's a lot of learning that a lot of people have to do. And as a player, whether it's self-regulation that Chris was talking about, or, regular regulation, we as industry participants have a responsibility, to work with not only with our clients and investors, but also with regulators, I think. So we do our best.
Yeah, I think, in looking back at 2017, it was, not so long ago, but so many developments and improvements have happened since for institutional investors. Like banks weren't allowed to legally hold crypto back then, and they can now. We've had major U.S. companies announce that they're holding Bitcoin in their balance sheets. JP Morgan and Goldman Sachs, who said Bitcoin was like the worst thing ever, and Jamie Dimon would fire anyone who was holding Bitcoin. All of those banks are now offering their clients crypto products. So it looks like there's so much work to be done. But if you look back at just what was the state of things in 2017, there's been so much progress. So that makes me optimistic, even though it seems like we're seeing so many negative headlines. When you look at the actions that all the major, companies, banks are taking, it's all extremely positive. And then, and not just like private companies, but also government, with El Salvador adopting Bitcoin as legal tender. I wanted to touch on this topic, even though we're coming to the end, but it's just like such a huge milestone for crypto that I'm wondering your thoughts on this. Like, do you think we'll see other nations adopting crypto as legal tender? Do you think it will be Bitcoin? Charles, do you think maybe a stable coin would be better suited as legal tender? I don't know. Would love your thoughts on this, and then we'll open it up for questions.
Well, legal tender is a complex subject, because that's basically a country deciding what it wants to be able to accept. And then, so in the case of El Salvador, they decided to be able to accept Bitcoin, but that was unusual. I think there's a question of what's the right legal tender to use. Clearly, the dominant world currency at the moment is the U.S. dollar, and I think it will stay that way. And it'll stay that way, especially if we embed the right technology in how it's able to be used and distributed. Of course, there are other things that go into why a currency can stay as a world currency, specifically around, inflation and stability. And so that's a different question that is above my pay grade, but that kind of leads into whether or not some other world currency might be used, whether it's Bitcoin or otherwise. And historically, the way to make an effective world currency has been to base it on energy, which is basically gold was energy. Effectively, you dig out of the ground, you know how much you used, and you know what the price is worth, and everyone decided to basically more or less coalesce around that. And Bitcoin, the case for Bitcoin, at least, whether that ends up being the case or not, ultimately, is that it's basically energy too. And having a currency based on energy really ties the currency to the real economy, because the real economy is just around transforming energy. And you can, of course, do that without having the currency be explicitly based on energy. You can have it be based on just fiat capacity to tax energy. So I know there's a lot of complexity in those different points, but ultimately there's a network effect to currency, and the dollar has it. We'll maintain it. It needs to continue to upgrade. It needs to be able to continue to maintain the core attributes that make it successful. And then there are others things that are coming out, and they're kind of pushing the dollar to make sure that it stays relevant across all these different angles, and both from a stability standpoint and from a technology standpoint. And so I don't know if Bitcoin will be there. It could just be a reserve asset as opposed to a currency. That's definitely a possibility too. So there's so many things that are just unfolding here, and we're in unprecedented times in so many different ways. I think you're at moments where things are nonlinear, and so it's very hard to prognosticate, because the tails have gotten a lot wider than they usually are, and our mental models are based on the last 50 years. But there's times where, the last 50 years aren't going to necessarily be good ways of understanding what will happen over the next, 5 or 10 years. And I think, very unusual to quote Lenin, but I think he said something like, there are sometimes decades that happen in weeks and, weeks that feel like decades. And so, more or less. And I think that, this is kind of one of those moments here.
Definitely. And it's interesting in your answer, you discussed, whether Bitcoin would be the currency that's used, or if it's, the reserve currency, but there was never a question of another country potentially adopting crypto as legal tender, which, tells you the moment in time that we're in, of crypto really becoming an inevitable, and, everyone kind of figuring out the ways to get there with regulation and so on. But I think there's just consensus that it is the future. It will be the future plumbing on how everything from information to value to art and money is transacted. Such an interesting panel. Thank you, everyone. And now David will open up for our audience questions.
Thanks a lot, Camilla. We're getting incredible feedback here. Great program. Thank you guys very much. First one came in 3 parts. First, what are your thoughts about Gary Gensler expressing that the SEC favors futures-based Bitcoin ETFs over spot Bitcoin ETFs? Second part, specifically to Jan, when do you expect Van Eck's proposed spot Bitcoin ETF and futures-based Bitcoin ETF will be approved by the SEC? Third part, which I think you've somewhat answered, what have discussions with the SEC been like recently?
Right. So just to get the facts on the table, we filed for a futures-based Bitcoin ETF, which the clock runs out on that at the last week of October. And then our, I'll call it physically backed Bitcoin ETF filing reaches its last deadline, meaning it can't be delayed anymore. I think it's November 14th-ish. So that's the time frame. What I try to say, to understand where the SEC is coming from, they're not actually trying to design a product. It seems that way, but they're not. I think what Chairman Gensler is trying to say is that because he's very much struggling with this question of what is a security, it's clear Bitcoin is not a security. And he's not changing the SEC's stance on that. And it's in line with the precedent set by my helpful co-panelists here. So he's not, so he also has said that he's much more comfortable with dealing with regulated exchanges, entities where the SEC can interact with, or other federal regulators can interact with, right? So that's why he said positive things about the Bitcoin futures. And the horse has left the barn on that. There are plenty of mutual funds and funds generally that already own Bitcoin futures. So he can't very well say no, because he'd be disrupting a lot of mutual funds that are already in operation. So I think he's more just calling the present. I think that the SEC, it's very consistent for them to approve both products. So hopefully they'll make that leap in a matter of, what was it, Charles, weeks, as opposed to decades, to misappropriate what you said.
Great, thanks. Quoting Lenin twice now, and on the
David, I just want to weigh in on that question, because it's one I take particular pride in. Back in 2017, when the CFTC was approached to greenlight the launch of Bitcoin futures, it was a bit of a closely run thing. I mean, we took a lot of pressure from overseas regulators, some regulators in the United States. It's a story I tell in my book, full page ads in the Wall Street Journal addressed to the CFTC saying, please don't launch Bitcoin futures. If you do, it could collapse the global financial system. Well, we didn't engage in fear, we engaged in courage, and we went forward and greenlighted that. And today, the United States has the world's pretty much only transparent, deep, liquid, fully regulated market for derivatives on cryptocurrency, on Bitcoin and Ethereum. And I take some pride in the fact that the chairman of the CFTC, of the SEC, former chairman of the CFTC, looks to that market as the basis for an ETF. So in only 4 years, less than 4 years, it'll be 4 years in December, that market has matured to the point that perhaps, hopefully, it'll be the basis for an ETF market. But it's not that long ago. That's a week, those 4 years since we green-lighted that product, and it's turned out to be quite successful. Sometimes when regulators are willing to take some courage and move forward, it actually produces something. And the United States has got a long history of that. The United States has pioneered more new derivative products than any other country in the world. That's why the world looks to the United States to hedge their risk in different asset classes. And once again, it's happened with, in this case, cryptocurrency.
So just picking up on that as our next question, which you've partially answered, but do you believe regulation will aid in mainstream adoption then of crypto, or stifle innovation and therefore delay adoption?
Well, that's an either or question. I think it's probably the truth is somewhere in the middle. I think we've already demonstrated that regulation can aid and create a two-way market. You know, before there was a functioning crypto derivative market, there was only a spot market. You couldn't short it. So if you had a positive view, you could engage in the market. If you had a negative view, it was very difficult to express a negative view as to price sentiment. The creation of a functioning derivative market allowed both people that wanted to go long, people wanted to go short to engage. And so therefore price discovery is actually perhaps more accurate. But I'm not saying that's going to be the case in every regulatory response to new innovation, but that was a response that worked. Brian can point to a number of other regulatory responses that has helped further this innovation. But I think we're also seeing occasions where regulatory response is held back innovation, and ETFs may be one area that people might point to so far.
Yeah, I would just jump in and say, I think where the discussion of all of this stuff kind of has broken down is the world is in two camps. You either think that we're pro-regulation or we're anti-regulation. When the point is there's certain kinds of regulations that facilitate growth, and my personal view is that the role of regulators is to unleash growth on behalf of Americans in ways that don't create undue risk. It isn't to eliminate risk, it's to unleash growth and then to restrict the risk that is a byproduct of growth. So if you think about historical regulations that really help, there are things like, broadcast regulation or wireless spectrum regulation, where we make sure that cell phones can exist by allocating spectrum at this frequency to Verizon, at this frequency to AT&T, so that they don't, interfere with each other. That's a good thing. On the other hand, we also have a tragic history in this country of price controls and supply controls and things like that. For example, think of the ICC in the olden days, or airline regulation before the 70s, which were terrible, right? It was regulation, but it was bad regulation. So I don't think it's an issue of should we regulate or not. It's an issue of, do we believe that this asset class and this technology will unleash growth? And if so, we should create a framework regulation that does that. I don't think that's where we're heading at the moment. Where we're heading at the moment seems to be a view that crypto's super scary. Thus, we must constrain it. And that's just not my view.
Thanks. This question is for Charles. Do you see traditional financial institutions partnering with crypto firms to gain a foothold, or will they begin to build their own capabilities? And of course, I'm smiling because interactive brokers, something might have happened in the last week or two, right? So what are your thoughts?
Yeah, we just launched interactive brokers, which is great. When we look at our pipeline of customers, it has really ballooned over the last year. Partly because PayPal really blazed the path that a lot of people have reacted to, which I think is great for the industry, and it's bringing a lot of new types of access and users into the system. I think that in our case, we just focus on infrastructure, so we're not trying to focus on an end consumer or an end investor or an end fund, just B2B2B or B2B2C players. And what we found is that because financial services are so fragmented, meaning there's so many different types of firms interacting with so many different types of end users, that it's hard to invest in the end infrastructure in a way that develops the product cycles and puts the breadth of team to work like you can if that's all you do. And that's not really surprising, because if you look in the financial services industry today, the infrastructure providers tend to be specialized. Exchanges, payment companies, clearing corps, et cetera. There's not that many of them. They tend to be more of the common good, and they're spending all their time working and developing and coming up with how they can serve their customers really well. And it's very hard to do this and stay up with what is a rapidly evolving industry and still stay also relevant to your customers. So we look at this as it's a really good partnership where we can provide an infrastructural layer, but we're not trying to provide the end layer. And that differentiation is pretty common when you get into the mainstream adoption curve for most industries. An example being cloud with AWS. There's a perfect example where you could run your own servers, but you don't, or you could run your own mail server, but most people don't. And that's the beauty of decentralized systems is you could go do it yourself, but a lot of people are going to want specialized help, and that's what we do. And it's not going to be for everybody, but it's actually for a lot more people than you would imagine because it's hard to build the stuff.
Okay, thanks. The next question they want your crystal ball on: what will be the impact of President Biden's nomination for the head of the OCC, and what will have the impact of growth on the market for that nomination? What will be?
So that sounds like a question for me. Well, let me first say the process toward confirmation is a long and arduous one, and so this nominee will confront, I think, some challenges just because of her writings and her background. The way I think about this is, okay, so Professor Omarova has expressed a viewpoint that we should end banking as we know it, and instead of decentralizing banking and put more of finance in the hands of individuals, what we should do is we should center the financial system on the government, and particularly on the Federal Reserve, which should then play the role that banks or crypto currently play. So the way I think about it, David, is as follows, which is there are three possible paradigms of a financial system. There's a government-dominated system where the government runs the payment system, credit allocation, capital allocation, and investment. This would look a little bit like a China system or certain countries that have major, like a Saudi system almost, with a significant sovereign wealth fund and the government owns the system. There's a fully decentralized system where the people rule. That would be like a crypto vision one day, right? Where we don't need a central provider of rails. And then there's this funny, unholy world we've lived with for the last 500 years, which is banks kind of intermediate between governments and the people. What we're all trying to do in crypto land is push more toward an individual-centric, market-focused, choice-based model. The nominee is pushing in the opposite direction. It is we need the government to provide all of this for us and get rid of the middleman. So there are two ways of getting rid of the middleman: government or us. I think that what you will see is that even among some Democrats, the views of moving fully toward a government-dominated system is a really questionable system. I say that because when crypto was being debated in the infrastructure bill just a few weeks ago, what you saw was 55 US senators, including 6 Democrats, were on the side of crypto and against the side of a government kind of bigfooting of the space. So I think there will be some challenges to her confirmation. And we do know that if she is confirmed, her agenda will include, I think, eliminating a fair amount of the progress that Chris and I tried to make on our watch, both because she's not just the controller of the currency, but she would also be a member of FSOC and a member of the FDIC board. So the powers would be vast. And for those of us who believe in decentralization, I think her approach is probably the opposite of that.
Okay. Our next question comes in several parts. So let's just take the first one for anyone. Goods and services are priced in local currencies, obviously euro, dollar, et cetera. What would have to happen to begin to price goods in crypto?
Well, I can give a very quick answer. I mean, I know Chad could do this too, but I would just say the beauty of true peer-to-peer marketplaces is, people can bid and ask in any denomination that they want to. I mean, true peer-to-peer decentralized systems are incredibly efficient, right, at setting real-time supply demand. This is something we don't have today because today merchants have to guess what to price something in, and if they don't find demand, they have to change the price. So that's the beauty of a 24/7 real-time peer-to-peer system, is you always know the demand in any given currency.
And I make another point. I tend to think of Bitcoin as a commodity. That's what we declared it to be in 2015 at the CFTC. And although you don't find in the contemporary world a lot of major assets priced in commodities, you find commodities priced in currencies. You don't have to actually go back that far in time to find a world where everything reverted back to gold, where in fact gold was the standard by which currencies were measured, and therefore commodities. So the notion that you could have a commodity as a benchmark pricing tool is not that far off in human history, although it's not that prevalent in today's world. It could very much become one again.
Right. And I guess, Chris, just one thing we ought to also overlay on this conversation is, we're in a weird monetary environment right now where inflation that we had not heard of in 40 years is suddenly back. It's not completely beyond the realm of the thinkable to think that even the stable currencies of Western Europe and the United States will over time debase. They won't do it as fast as Venezuela or Zimbabwe, but at some point they will, at which point some other medium of exchange will arise. Is that Bitcoin? Maybe.
Brian, I have to make the historical point. No paper currency has ever survived.
Correct. Right. It's only a question of how long can it survive, but it all
exactly. It might be beyond our careers, but it will never not survive forever.
Correct.
Yeah, commodity-based price standards have been more the norm in human history than have been paper fiat.
Yeah, and I agree with that. And I think the reason is because it's tied directly to energy, which is what the underlying economy is, and paper money isn't. And I think that because of the way decentralization works, as Brian was pointing out, and it makes it very easy. It's just code, which asset you're using. So there's no reason you couldn't trade gold for dollars, for IBM shares, for a car, for some collectible. It can all be fungible against each other. When you get to that point where you have enough assets that are all residing in a system that's able to move real time and create equivalency between them. And so I don't think you'll necessarily abstract away from a unit of account. And so, there'll be a question of what is that unit of account, but there's no reason why you can't simply move different types of assets between each other and potentially just on a swap basis.
Add something here. The world where some assets are priced in crypto is already here. We're seeing it in DeFi. Assets are being priced in ETH. They're not being priced in US dollars. If you go to any NFT marketplace, all of the prices are in ETH. Even in traditional art world, this is also seeping in. Sotheby's recently had their first auction where it accepted ETH in exchange for NFTs for Bored Apes and CryptoPunks, and those assets were priced in ETH at Sotheby's. And beyond collectibles and NFTs and art, you're seeing things like collateralized loans. The main collateral used in those automated loans is Ethereum. It's not US dollars. So this is already happening. It makes sense that it's happening natively in decentralized finance because you are transacting with digital currencies. But I think the tendency is that more and more of economic activity will go from the physical to the digital world, and it will just make sense that these assets and goods and services will be priced in digital currencies, and whichever is the digital currency that's the most used at the time. Right now, it just happens. Most of the activities happening on Ethereum, so those assets are being priced in ETH. We're already seeing it.
Great. We're already into overtime, so let's do one last one before we wrap up and narrow the panelists. You need to help us because there are now thousands of different crypto tokens. What particular kinds of tokens and networks do you see retaining relevance and value in the markets, and which ones do you see the most potential in?
I'm happy to jump and just offer a couple. First of all, I think Bitcoin will always be here because Bitcoin is really the tracking stock of decentralization overall, in part for the reasons that Chad says. And that is, it is the relatively price stable energy-based replacement for gold. And that's always going to be there for a bunch of reasons. I think that there's going to be a category of competitors for the smart contract platform king, and it may or may not be Ethereum, right? I mean, Solana's run up has shown us that the ability to build something that is faster and with lower gas fees is potentially a better platform in the long term, but Ethereum already gained scale. So somebody will win the smart contracting and kind of DeFi platform race. And I think it's so early in the world of NFTs and their connection to metaverses and things like that, there's a whole sort of creator economy thing out there that we've only begun to see, which is huge and really exciting. We don't even know where that's going to go. And then that's before we get to the cat and dog projects that are all interesting in their own right. The file coins of the world, the things that aren't necessarily financial services plays or creative plays, but are still decentralization plays. And how many things in our world could be done without central control. So I think all of those four categories are worth watching.
Anyone else want to chime in? Well, thank you. This has been a phenomenal program. We want to thank our lead sponsor, Protiviti, our co-sponsor, Van Eck. Thank you, Camilla, for moderating, and to Brian, Jan, Christopher, and Charles. Much appreciation. We look forward to seeing you at upcoming events in October. And remember, consider supporting the museum through text to donate or through crypto. We'd be happy to accept your donations. Thanks, everyone, and see you again soon.